It's another episode of the Wall Street Wildlife Podcast, and today we're going to answer the question, are we in a stock market bubble?
Badger, what are our predictions for Nvidia's earnings coming up on February 21st after market close?
And we're going to dive into the King of the Jungle challenge and see how we're both doing. Who's winning? Shortcut, I'm still ahead, but by how much? Fun-packed episode today and super timely with Nvidia earnings coming up.
I'm Christoph Monkey Pikarski.
And I'm Luke the Badger Hallard.
All right, Badger. So later this week, February 21st, Nvidia reports earnings. This to me feels like a extra special earnings announcement, in part because of Nvidia's gigantic market cap, currently at $1.79 trillion, a stock price that has risen from, in a year, from 100 something dollars to over 700. And it seems to me that Nvidia, kind of like the elephant supporting everything else in the jungle, carrying with it a lot of the semiconductor companies and tech, that should something unsavory show up in the earnings report, the entire market, and I don't exaggerate, is at risk for potentially a strong to severe correction. How does that sound to you?
I think I agree. It concerns me. I own a ton of tech stocks. I own some Nvidia, although I have trimmed it recently. Twice now, trimmed it. Let's talk about bubbles more generally, though, and then let's loop back to whether we think Nvidia is leading the AI bubble and dragging all of tech stocks with them. So what is a bubble?
The way I think of a bubble is something unsubstantial. I like the image from Shakespeare, or maybe it's not Shakespeare, but the image of something floaty that is in the air, not grounded. So when I think of bubbles, I think of the obvious example, the tulip mania, which is a pretty standard economic test case where human beings are capable of investing everything into something that provides no fundamental value simply because everybody else is doing it. That's one example, right?
Yeah, that herd mentality. Like you see guys over here making money and you're like, oh, I need to jump onto that bandwagon and make money alongside them. And then you get this irrational, self-fueling exuberance which drives an asset. In this case, we're talking about like semiconductors and AI chip manufacturers, but it drives them to just wild, potentially unsustainable valuations.
Right. And another famous example of a bubble was the early internet boom followed by a bust, where the idea was a great one. The internet, yes, and the idea came true. The reason that was a bubble is that out of the however many thousands of companies that started in that time, many reached extraordinarily high valuations, and only some of them were able to build foundations under their dreams. And so most people invested statistically in the companies that failed to provide any substantial value. The question here is, to what extent are we in a bubble with AI chips? Translated as, is there something substantial that's being built here, or is it all mostly fluff?
Yeah, and I think the Gartner hype cycle, if you've not heard of that, brings that idea to life really nicely, that people get excited about a technology, you get this exuberance and this expectations about what this technology will do for you. And so, in the case of the 1990s, all of these e-commerce websites and these big ideas, but you don't actually have the capability to deliver the value, the true value. And the true value comes once the bubble pops. Everyone goes, hell, this was a dumb idea. Everyone kind of moves on to the next big thing. But in the background, like the real builders are building the capabilities. And at some point, maybe years, maybe decades later, those good ideas eventually do come to pass and they do deliver true economic value. And that's the time you want to be investing in them.
Can you share with us the bull case for why a company like Nvidia, the leader of AI, everything AI, suggests that we are not in a bubble.
It's a hard one because I am an Nvidia bull, but at the same time, I have to sort of hold these two conflicting ideas in my head. I'm an Nvidia bull long term, but right now the valuation feels like there's a lot of optimism built into it. But yeah, let me share some ideas around the bull case. Just using large language models, like I probably talk to ChatGPT and Gemini right now more than I talk to any other human being. I get so much value out of conversations with these tools to help me understand my own investments, to help me understand the world better, and in some cases, literally talking to these things. And if I'm getting value out of it, there are thousands of other companies that are getting true value out of this stuff. And I think the bull case is the ever increasing demand for more and more power to fuel these capabilities. And so I think we've seen two announcements in the last couple of weeks, actually, that give us a roadmap as to where these tools are going, like the next stage of these tools. And I'll pick out two, and you can go and maybe I'll put some Twitter threads in the show notes. You can go and do your own little research and look at some of these videos I've seen. So the first one is OpenAI have just announced a new model called Sora, S-O-R-A. I don't know if I'm pronouncing that correctly. And Sora, essentially, maybe you've seen our podcast. We've got all these fancy kind of pretty pictures of animals doing their shit in the jungle. And that's just us putting some words into the ChatGPT and saying, give me like a badger and a monkey, like playing American football. Well, Sora, you can now create very compelling, almost indistinguishable from reality video just from a description. And OpenAI have got some fantastic examples on their website of that. This is in like super closed beta right now, but these capabilities are going to get released to the public at some point. And when they do, OpenAI will make a ton of cash out of it, but they're going to need a ton of hardware behind them to be able to produce those videos. And I think in the news, Sam Altman, the founder of OpenAI, has recently announced that he's trying to raise $7 trillion, I think mostly from the Middle East, to fund like the next wave of AI. So there's one part of the bull case. I've got another example to do with Gemini 1.5, which I think is fantastic, but let me give you some airtime.
Here's the concern I have is around the question of commodification. As far as my own research goes, Badger, Nvidia, and I'm not an expert by the way, but I mean I've read some stuff. I've read books about this stuff, but yeah, I don't know the industry from the inside out. Nvidia is the only company that truly has what I would think of as a moat because of the way they integrated the software capabilities on the chips themselves, and they're the best in the world. And so they're the company I'm not worried about in terms of commodification. But, and I don't know if this analogy is good enough, but like the internet bubble where routers and I guess internet equipment, the demand for it was so robust with no end in sight, because it's true, the internet kept growing and growing and growing. But if you go back and look at the share prices of the companies that provided internet infrastructure equipment, like Cisco, for example, the stock price is terrifying because it ascended incredibly quickly and then it plummeted just as fast because eventually everybody who could was able to make that kind of equipment. So again, outside of Nvidia, I'm not sure I feel good about too many of the other AI chip makers and equipment providers. And Exhibit A is what happened on Friday with Supermicro Computer. They kind of help companies put together all the things that they need to make a chip. It seems to me that they are not like Nvidia because what they do is not, there's no moat to it. It's just that it's a necessary component in the AI roadmap, in the chip making roadmap. Their stock was at $300 in January. A month later, it was selling at some point on Friday for close to 1,100. That's like, call it a 4x in a month. This has flashing warning signs to me of a bubble. You take a correct industry, you take all the rage, you take products that every company needs it, but in the end, a product that can be commoditized, this does not end well.
I don't know if that's what it comes down to, like commoditization of the chips. Probably, ultimately, yes, but companies like Nvidia, and this probably is agreeing with you, not disagreeing with you. Companies like Nvidia aren't just building the hardware; they're building like massive software ecosystems that work with the hardware, and the value is going to come through the mix of the hardware and the software. I think the really interesting question is, if we just think about large language models, like the real value is going to accrue to whoever owns the data. So companies like the social media networks, like Reddit, for example. I just read this morning, Reddit have done a deal to partner with an AI firm, sell access to their data, and suddenly, you've got a model that can be trained on this massive corpus of like garbage plus real insight. I mean, Reddit is such a mess of interesting stuff. It's companies like that, companies like Alphabet, that have, now suddenly we're talking about generating video and being able to understand video and understand what's going on. Companies like Alphabet that have like exabytes of video with petabytes of video, new video being uploaded, every week. Nobody in the world has that volume of information. And so these models are going to allow companies like Alphabet to extract value from those masses of data in ways we've never been able to do before.
So here's where this conversation leaves me. I would be sleeping moderately okay as a long-term shareholder of Nvidia at these prices, even at these prices, because they are not selling tulips. They're selling the call it the blood, the heart and blood of everything that is being built with AI. However, pretty much every other chip maker AI associated company in this moment, I would be having nightmares if my portfolio had large allocations to those. In fact, I think, as I shared to you privately, one of the next purchases for the King of the Jungle competition, it might be me shorting the semiconductor space overall. But I will not do that, regardless of how much risk I'm willing to take. I'm not willing to do that before Nvidia's earnings, because in this kind of FOMO stage, if their earnings are absolutely stupendous, then, which is possible, then the industry, that gap between fundamentals and price will continue to become exaggerated. So I'm not going to lose all my bananas trying to time this. So that takes us actually to the second to the question of what share price are we going to see, Badger, on Thursday, February 22nd, the day after Nvidia reports its earnings.
And so let's make a prediction. And I think we're probably going to get together in person in the next month or two. So how about a wager of first round of drinks or dinner on the first night and let's say it's the share price at close of business the day after, because it gives a day for like all the weird shit to kind of play out. So close of business on the 22nd.
Okay. Well, today we're recording this while the market's closed, but we're at $726 per share at a $1.79 trillion market cap. I'm going to go, this is so hard. I'm thinking that the earnings are going to be terrific, maybe even spectacular for this quarter. I am not as convinced that the demand and the pricing power that they're already seeing, that they'll be able to project confidently out into the next quarter at the same rate. So it's the guidance that might potentially spook the market, and yet there's something that tells me, man, this thing's going to 800. So this is a hard one. This is a hard one. You know what? I'll go with that. I'll go with that gut instinct. I'll contradict my own reasoning. I'm saying Nvidia is going to close at 798.
We've both tried to screw each other over because we had a conversation pre-recording, and we're both like, "Yeah, we think it's going down. I think it's going up as well." I'm going to substantiate my argument though with some real numbers. So, like the company is trading at 103 times free cash flow today, which is the key valuation metric I've had my eye on for the last like 2 years since I've been an Nvidia shareholder. Uh, I've trimmed my allocation to it twice, most recently 10 days ago. For me, it feels I'm comfortable having a 2% allocation in Nvidia, but I think it's way overvalued at 100 times free cash flow. But then if I look back at last quarter, like really the key metric that gives you insight into their demand are remaining performance obligations or deferred revenue, essentially like money that they know is coming in because like they're delivering product but they haven't received the money yet. And that's just been climbing nicely. Like the deferred revenue is growing as a percentage of total revenue. And I think they're probably going to do that again, thinking about like the Sam Altman $7 trillion demand, just as one example. So, but are they going to climb like 10% essentially from like 730 to 800 was your bet? I think they are going to increase, but I'm going to be a little more conservative, and I say we're going to see 750 as the price because there's so much optimism built into the stock.
Okay, so between 750 and 798, the truth might lie. I would be shocked. I would actually be shocked if the guidance is problematic enough to make it drop. So I think we'll both end up being right in directionally. But who will be drinking the nice whiskey in Austin a month from now for free? Tune in.
All right. Okay, it's a whiskey bet. I'll buy that. I like it.
Uh-huh. I got a couple of joints in mind, Badger.
Great.
Couple jungle branches that only the real monkeys in Austin know.
Alrighty. So that was one stock we dived into. Did we answer the question? Are we in a bubble? I think we just don't know. Nobody knows. You never know when you're in the bubble, if you're in the bubble, or if you're in this like steel box that's super secure.
My answer differs. I'm saying we are in a bubble, except I'm saying Nvidia is not a bubble. Everything else, chip related, is actual bubble territory.
Okay.
Yeah, bubble. I am saying we are in a semiconductor bubble.
I will. I look forward to criticizing you when you do take out your semiconductor short bet. That's playing with fire, my friend. That's definitely playing with fire.
Okay, so far you've been right each and every time, and you are whooping me. So
Well, let's find out how hard. Should we take a look at the King of the Jungle, see where we're at?
sure, let's do it, Badger.
And just while you're pulling the graph up, quick reminder. So if you're tuning in to a recent episode, we haven't talked about this for a couple of weeks, but way back in episode 1, we started the King of the Jungle challenge. Christoph and I have a very modest portfolio of $1,000 in real money each. We're adding $100 every month. So I think we've now added what, $1,400 to our portfolios, and we're just managing them. And we have them. It's real money. We have them on actual trading platforms. Go back to episode 1 and 2, and we'll talk about it a bit more. But yeah, let's see who's winning, who's grown their investment the most.
Yes. So right now, from the original base of cash, your humble monkey is at 1,266. So I'm down about $34. And you, wise badger, are at 1,489. So you've gained about $189 off of your initial investment base. So there is a sad for me delta of $223. at the moment.
Okay, there's not much in it. It's like 10 or 15%. That's you could easily catch me by the end of the competition in September.
Oh, all things are possible. All
Oh.
things are possible.
Ah,
Uh,
ah, ah.
but what's interesting is the way our strategies have and have not worked. So far, basically, we started this competition right at the lows. Like there was a real market low where pessimism was the name, and you got into some excellent companies, quality companies at truly mouth-watering prices from relative in that moment.
Yeah, my portfolio is looking like it's in pretty good shape. I own what, seven, 8 things, and 7 of those 8 things are all up. A couple of them really handsomely. CrowdStrike, nearly 80% gain. Mercado Libre, nearly a 50% gain. You might remember I bought my only ETF. It's an India ETF tracking one of the major Indian indices. That's up nearly 25%. Rocket Lab 20%. Wise, the fantastic like travel money FX company, they're up like 20%. Axon are up about 15%. And even my recent purchase of Samsara, ticker IoT, even that's up about 8 or 9% since I bought it. I've only got one stock that's underperforming, and sadly, that's underperforming my real portfolio too. That's the Chinese auto manufacturer BYD.
So far, your strategy to buy excellent companies is working like a charm for you.
So far.
Yeah, and I started this competition in a very different frame of mind. I was thinking that the macro context is really precarious and that the valuations of a lot of these companies were already stretched. So I was looking in the proverbial dung heap pile for companies that I thought whose valuations were non-existent essentially because they were mostly pre-revenue in the case of EOS and about to climb in terms of revenue in terms of Coherus. Both of these small cap companies of mine have not yet performed whatsoever. So they are close to break even. EOS is, I've been dollar cost averaging, but I have nothing to show for it. However, I do have a company that's almost up 100%, which is CleanSpark, one of my 3 Bitcoin miners, the other being Cipher Energy and Bitfarms.
And you've got a load of closed positions as well, right? You've bought and sold some things that have performed pretty well.
Yes, so in order to double down, I'm sorry, not double down, to dollar cost average on both Coherus and the EOS, which remain my top 2 picks, I sold Relay Therapy for close to 50%. I sold a little bit of Bitfarm and Coherus 20 and 15% respectively. And a little bit of Chainlink. I talked about why I sold that earlier. That's just a platform issue at 30%. So I've taken profits, a little bit of profits along the way. However, I also made a boneheaded move, which I talked about as soon as I made it, and I just never backed out, and it worked out the way I suspected it would. I bought, instead of shares of Rocket Lab, I used technical analysis to look at momentum and thinking it was going to go higher. And in that kind of short term momentum based mindset, which is a probabilities game, when you add a date, you have to be right. So my reward was going to be very, very high, but the risk was it coming down to zero. And that's what ended up happening. So I lost $42 on my on my Rocket Lab misfortune. And as I spoke about it, uh, it was very obvious to me that it was a mistake within a week. And already at that time, the market had a really nasty down day, and the options lose their value very quickly if the momentum is not sustained. So uh, there's a good lesson here: is that if you're playing it safe, go Badger's route, which is you buy the shares and you're not under any kind of time constraints. If you want to take the higher risk, higher reward scenario, you need to understand, like I did, that it could very easily go to zero and then you're playing catch up.
Yeah.
So I have a nasty splotch on my record so far.
Right. I think there's another interesting difference as well, which actually I find quite meaningful. If I buy shares in Rocket Lab, like I feel like I'm directly supporting the company's mission. Like ultimately, that money is flowing back into the company if they've issued new shares, for example, and they can then use that to, they can use my couple of $1,000, whatever I've essentially given them by buying shares. They can use that to make acquisitions, do other stuff, like directly support the mission. If you're buying or selling derivatives, like options, you're buying puts and calls, all you're doing is really standing on the sidelines and speculating with other gamblers about the trajectory of the stock. So I think there is a different sort of emotional feeling to being a shareholder versus a derivatives trader.
I think there's a fallacy there. Correct me if I'm wrong, but companies don't benefit from the price of equities after they've already been sold. So Rocket Lab already received all the money from their shares, and whether people own it via the shares, common shares directly as they're known, commons, or via derivative instrument, second order like options, to me, it equals the same thing. Money is not flowing in or out of the company's pockets.
I'm going to sort of disengage my emotions and say, yes, I agree. Technically, you're absolutely right, and there's no difference. But this sustaining this perhaps false belief helps me stay the course with my high quality companies when the share price goes down, because I truly believe in the mission and I feel that I'm helping the company. So this is almost a psychological trick I deliberately play on myself to help me be a long-term investor.
Yeah, so as I zoom out at where we are in this competition, I did not foresee, honestly, that we would have almost like inverted representation of two strategies, the two dominant strategies of being an investor. You are clearly representing long-term buy and hold. You've only bought, you haven't sold, and you've picked what you thought were the most excellent companies in the market. I thought I was going to be doing more of a flexible thing, like I was gonna take advantage of different instruments and consider valuations, kind of have a more motley type approach. But what's ended up happening predominantly so far is that I'm mixing short term strategies with some market timing, with valuation principles, and my portfolio at the moment is, it feels messy, to put it that way. The reason I stopped myself from saying I'm only doing short term stuff is because I bought Coherus and I bought EOS and I bought my bet against regional banks, and despite the ups and downs in share price, I have not been doing any selling because, like a long term investor, I believe in the thesis for which I bought. The only difference is those companies are not great companies like the ones you hold. It's an issue of valuation. So in this moment, I've been essentially wrong about my three biggest bets.
But it is interesting. I didn't foresee us going this direction either. And I think what we're doing in our portfolios mirrors what we're doing in our real money portfolios. Like, there's not a massive difference fundamentally between my King of the Jungle portfolio and my real money portfolio. And I think similarly, you own the stuff you really own is somewhat similar to the way you've kind of played both sides of it in your King of the Jungle. And this isn't a reflection on you per se and the approach you've taken being inferior. It's just that where we are in the cycle right now, in the economic cycle, that's rewarding long-term investors. So therefore, I'm outperforming you. But there will definitely be times in the cycle where your strategy will succeed. And every investor has to find their own way, their own blend, their own approach.
Yeah, and I'll comment on that, Badger, by saying when the times are good, it is so much easier being a long-term buy and hold investor. I mean, it's easier in every way. You don't have to work as hard, you don't have to stress as much, you don't have to look at charts, you don't have to, I mean, so much to recommend that approach. However, when you're a long-term investor and there is a drastic sea change, and there will be, it is deeply, deeply unpleasant if you don't have alternate strategies um, at your disposal. So right now I'm eating crow. I'm not wishing necessarily for a gigantic market drop, though, as you know, I do have my second largest position is a bet against regional banks because of the data I'm seeing in commercial real estate.
All right, so yeah, I guess at the moment I'm winning in the King of the Jungle. Anything can change between now and the end of the first year, and certainly the contest doesn't end after year one. Like this is really a lifetime endeavor. This is a 20-year contest, really. But we're gonna wager on who's winning at the end of that first year. So let's see. Now, I did notice in your King of the Jungle portfolio, and presumably in your real money portfolio, you seem to now own more than one Bitcoin mining operation. What's going on there?
I am growing increasingly confident that Bitcoin as an asset class is now in a new period of its young life. So it's what, 15 years now? It's year 15.
Sure.
But with the approval of the ETFs only a couple of weeks ago, I think Bitcoin has fully arrived as an asset class. And so I want to so instead of buying Bitcoin directly, I think there's more upside in investing in the companies that make Bitcoin happen. And there's quite a lot of them. So I tried to pick three of the ones that I felt had the greatest upside based on the different kinds of, call it technical strengths they have and how many Bitcoins they're actually producing. Essentially, Badger, the price of Bitcoin will dictate the value of these companies. So this is almost like a second order play for me. It's not entirely true because another company that I'm thinking about pitching for Seven Investing is kind of couched in green energy plus AI cloud computing plus also we mine Bitcoin. So it's a lot of these highly technical data center type operations that because they're also associated with Bitcoin, if the price of Bitcoin continues going up, then the amount of value that the Bitcoins they've mined on their balance sheets goes up, and it's kind of like a one to one. The reason I'm as excited as I am in this industry is because I do believe, and this is a belief, so of course I could be wrong, that we have not seen Bitcoin's price come even close to what it will be in the future. Meaning, it's all relative, but it's not, for example, we're at what, about 50,000 per coin. It's entirely plausible to me that we're going to end the year at 100,000, meaning like 100% gain from here. Therefore, the Bitcoin miners would obviously benefit. Why am I even thinking like this? I think for many people, Bitcoin is still feels unreal to some extent. Like, because, I mean, it is like money. It's unreal. It's digital. It's, and there's not even that many, relatively speaking, people who own it. I don't know what it's 100 million wallets or 130 million. I should find that number, but it's not proportionally. It's not that many. However, it's fascinating to me because this image I found from Michael Saylor's MicroStrategy. He's a big Bitcoin shiller, or maybe, well, shiller, and he walks the walk. His company just kept buying Bitcoin nonstop. Since 2020, August of 10th in 2020, the price of Bitcoin compared to gold has risen 334% higher. Bitcoin is up 333%, gold is down 1%. My insight is gold is not just a mimby-pimby asset class. It's not like a company among a bunch of companies and might work or might not work. Gold is the world's largest asset class, still. Meaning, if you think about that for a second, Gold is the dominant form by which human beings store money. And relative to gold, Bitcoin has outperformed it by magnitudes. So I think what I'm saying, to unpack this a little bit, is I think it would be a false comparison if Bitcoin was, say, up 300% compared to some other shit coin. But it's not. It's up that much compared to the realest form of money we have had. So I'm taking it seriously, very, very seriously. And as an investor, I don't want to miss this, what I call very clear turning of the tide, where Bitcoin evolves even further into a legitimate way of investing, and the Bitcoin miners are how I will partake in it.
And do you want to tell us who your 3 miners that you own are?
Sure. The one that is up close to, actually was up over 100% at one moment, is Clean Spark.
Mm-hmm.
And then there are 2 smaller ones. One is called Cipher, CIFR, and Bitfarm, BITF. And I have another one on my radar. Subscribers to 7 Investing will find out what that is in the coming week.
Fantastic. Look forward to hearing about it. Well, hopefully these drive your King of the Jungle results to contest winning levels. I don't want to win by a massive margin. I'd like to win by just a little bit, where we're both ahead. All right. Good conversation today, Christoph, as ever.
Likewise, Badger. Thanks for continuing to not give up on me and teaching me things.
Look forward to getting together in the flesh, and we'll be recording several episodes, multiple of which will be probably very drunk behaviour on camera. So find a friendly bar to pitch up our setup in. If you're enjoying our conversations, this is the Wall Street Wildlife Podcast. You can find us on all major podcast platforms. Tell us if there's one we're not on, we've screwed up. You can also find us on YouTube. If you want to see our ugly mugs, just go YouTube for Wall Street Wildlife.
You could find Badger at 7 Luke Hallard on X. I am at 7 Flying Platypus on X.
We've also got a website, wallstreetwildlife.com. We are right now, we're nearly in the midst of finishing writing the 10 laws of the jungle when it comes to investing. So give us another week or two, we'll have it live on the website. You can go sign up and you can get a copy of that. Some good insights, I think, there around, frankly, lessons we've learned the hard way by breaking these laws, breaking these rules. And so we'll share our wisdom with you in written form as well as podcast form, so you can hopefully avoid making those same mistakes.
That's right. Hard-earned jungle wisdom. Are you ready to become a beast of an investor?
Your journey starts here.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged to consult a financial or tax professional.